Hey, welcome everyone to the second episode of Supply Chain Management Podcast. I have Satya here. He got us some special guest on his background.
Yeah, good
Thanks for
morning.
joining on a busy schedule. Uh, you have a different
Yeah,
background for this episode. You are
yeah.
sitting in a different room.
I thought let me change the rooms so that people get the overview of my entire house during this podcast. Anyways, yeah, it's a good Saturday morning. Welcome, Uday. All right, so let's talk about what's happening. Like we see a lot of bloodbath happening in the corporate world. Every morning when I get up, I keep hearing about this company is going to fire these many number of people and all, and especially it's happening in the big companies, and quite a considerable amount of workforce is getting fired, which is like it varies from 5% to 10%, and it is happening across the sectors. Of course, not just tech companies, but yeah, even the startups. I can see that they are hiring considerable amount of workforce, which is coming close to 10 to 12%. So I have been thinking a lot about this, but then before I give my point of view there, I would like to know what is happening, why it is happening, and what can be done to prevent this kind of situation in the future.
Okay. Yeah, I'll just give my point of view on it. It's not necessary that I'm accurate, but this is what how I'm reading uh, the
Mhm.
situation at the moment. So first thing is, I think if you see some stats, somebody was putting on Twitter somewhere that Google doubled its workforce in a matter of 3 years. I don't know, it's the same for all other tech companies, but it's been a quite a rapid sort of increase in the workforce. And
Okay.
I remember anecdotally hearing from a lot of the guys, especially who work as software engineers, that there was like a huge fight for talent the last 2 3 years, and then the salaries were
Mhm.
crazy. That's what I heard. So normally the cycle, the way it goes is you hire ahead of the growth, right? Because you need to train people, get them up to speed. Only then they
Correct.
can start contributing, whether it's for making a product or sales or operations. So I think the companies were hiring for growth. Now that the macro picture has changed, they have realized that there are a lot more people, and these are all the companies being public companies. They are trying to manage to a certain sort of earnings per share and profit
Mhm.
pools. And then when they're
Yeah.
doing the next year planning, I think they're making some assumptions based they're seeing in sales pipelines and other places. And suddenly we are coming to a point where these companies want to actually take some workforce away and prudently try to manage their cash flow and profits. At least that's how I'm reading it. That's the broad thing about layoffs. But I just want to highlight one point before I turn it over to you regarding the COVID. I remember seeing this beautiful graph talking about retail, e-commerce retail in US. It's very specific to e-commerce retail in US. I think at the time was 15 or 20% penetration. I don't remember, and it may I can be inaccurate in the categories it includes, but they said, hey, it went from 15 to 30% penetration in matter of months or something like that, right? And then I saw another chart like more recently, like 5 6 months back, was that 30% penetration has come back down to the trend line. So the trend line would have been in 2 years, you would have gone from 15 to 20. Instead, it went to 30 and came down. So there was a big miscalculation from the and then narrative numbers everything actually drives this, right? People thought it's a penetration which went up, but it was actually combination effect of COVID where you could not shop inside a store, that you're going online, and then effect of retail sales exploding because of the stimulus checks in US. So it was more of a retail sales bump and less of a penetration effect, which was the thing. So that was a huge shocker for a lot of e-commerce companies like Amazon, Shopify, others who invested extremely aggressively during that time. And this was a huge narrative they it was driven. So I know a lot of people acknowledge that they got it wrong and all that, but I mean, it's a great reminder for all of us that when things are not moving at a probably reasonable band of pace, normal pace, you should probably question everything, whether what will happen. We don't know, right? Anyways, I'll turn it over to you on how you are seeing these things.
No, that's an interesting point you highlight about how the companies have are predicting their growth, right? So, off late, if I have to, read each and every CEO statement, right? But high level, what it boils down that they have over predicted their growth as such. And as you're right, like whatever things they have seen post COVID, that I would say kind would have been kind of an outlier, and that outlier basically they made an assumption that they are actually their market cap is growing or whatever the industry in whichever the company is in, they thought that they are shooting up in terms of growth, and those growth was like in terms of percentage, it was like something they have been doing from the past 20 years, and suddenly they are seeing double the growth in just few months as a matter of time, and which actually triggered this to have them hire more and more people, which I do remember during COVID time. I used to see a lot of people getting hired left, right, and center with 2x 3x of packages. Suddenly we see that the talent pool was in so much of, especially the tech talent was so much on, it was so much in demand, that the salary started exploding. We can see that and that the hiring was not even coming down, and now we see that, especially and we can retrospectively, if you go back and think that, okay, whatever hiring they did actually at that point of time, it turned out to be that the growth they actually miscalculated. It was not actually the realistic growth that they were seeing, but it was more of a COVID impact and other factors that drove this growth, and they have to come to a point that they have to actually correct, they have to do this course correction. And but course correction, it has actually impacted lives of many people, because if I have to say 10% of workforce, it is a considerable amount of workforce which is actually goes in thousands. And I'm sure if we aggregate of total layoffs that have happened, it will go in like some millions, I would say. So that's a
I,
quite
I,
a
I
amount of.
think I don't know the exact stats on the layoff, but there is a website I think composed by somebody. I think he's a startup founder. He has a website called
Mm,
layoffs.fyi, I think.
mm,
In that,
mm.
he's tracking all the layoffs for tech companies. It's an interesting website to really
Okay,
browse. I think when you
okay.
get a chance, you guys can actually go ahead and look at that one. They
So,
talk about the stats. But I
right.
think on that point you're talking about the overhired, I don't know if I completely agree with you that. It was was it a mistake of a degree or magnitude, or was it that they completely off? I think there's a combination effect in certain companies
Mm,
like e-commerce. I think it was a complete sort of a narrative driven thing, but in some other places, let's say like cloud and other places, maybe it's the rate of growth they were expecting is sort of coming down because of macro, and not so much of they were off with respect to the fundamental nature of things changing. The adoption was really going right. So that's a difference. I'm saying in e-commerce, the penetration did not go. It came back to the run rate where it was. In cloud as well, the run rate. I don't think the run rates actually jumped big time like e-commerce. They jumped reasonably amount, so it was a little bit of a pull forward effect, and with macro maybe that's where we are seeing the hit. And then on the third one, like normal companies, let's say refrigerator, TV companies, they see this one time huge discretionary spend, right? So for the next 2 3 years you're not going to see huge sales on big ticket items, so we are going to see like a huge effect of that for like a year 2 years of lull before the normal trend catches up with the sales on those items.
could it be a factor of FOMO, where even the companies I realize, I know it's a combination of so many things, but could it be a fact, especially for the growing companies, which they believe that over a period of time their market penetration is going to go up, but when they see this kind of outliers, suddenly they with the rate at which they are growing suddenly shoots up. It's a steep hike they see. Is it? I know they have their own strategies to do this. They do invest. They do invest in the in terms of workforce hiring. Having getting buying new buildings or whatever it is. They do this whenever they see that the growth is happening. They do this annual investments, but like when they see these kind of outliers, when there's a sharp increase and all, it could be one of the factors like fear of missing out, especially for the growing companies, and where there is a lot of competition, that
It
they think
happens
that
everywhere. I mean, I don't disagree with that because see, there is a positive bias effect you're going to have, right?
Mhm.
Second thing is that the talent war there was, especially for technology, like workforce, it would actually put some kind of a pressure on the recruiters because they need to have incentive to hire people, and that kind of a circular effect continues. And then stock prices are going up. Probably that makes people like sort of feel better, and it just felt like everything was probably doing okay, right? So I think it's an incredibly a weird time where things sort of distort your mind. And I think it continued for a long time in my mind. If it was just an year, I don't think people would have been sort of easily foxed by this, but it continued for 2.5 years. And I don't know, for many reasons, it was fairly obvious for folks in the US. I don't know how it was in India, but see, here in US, the home prices were like taking off big time, like unlike anybody has seen in 100 years. And Federal Reserve has been quite not raising rates for a long time for whatever reason, which is a outlier event. But anyways, I think we'll see how events unroll. The more important thing I'm not clear about is I think a lot of these companies are saying we're going to lay off 5%, 10%. I mean, how are they going to be sure that's enough? So we don't know. So we will only,
Which right, which actually brings down to the second level of question. Now we have seen
yeah,
the cause and effect over here. Now let's get into a second level details, like how basically the economics works out in the company, which actually the company comes out with this number, like
right,
hey, this is the workforce I need to fire off. I'm sure there must be some calculation behind it, right?
right.
Like they must be seeing, okay, this is what they might be projecting their revenue, and this is the workforce they have. It might boils down to how much and each and every on an average how an employee is contributing to the
Hmm.
revenue of the company, and they must be coming with this percentage. Now I'm a big fan of Simon. Actually, he's a philanthropist and entrepreneur who does talk about all these things, which brings to me this question: can't the companies look into the other ways of trying to restrict their variable expenses? It could be in the form of bonus, stocks, perks, or any other things. Like if the company thinks that, okay, their revenue is going down, or it might not go at the way they have projected it, and if it is falling short, are the companies even exploring this
No,
option
I
of
think
trying to?
that's all happening. I don't think from whatever you read in the news, you'll know that is all happening as well. It's all together. Uh, Now the other question you can ask is, hey, can the company doesn't have with the billions of dollars of balance sheet, some of the big tech companies, can they not absorb this for a couple of years and then let the demand catch up? That's like a question, $1 million question you can easily ask, right? And I don't have an answer for that. Why somebody wouldn't do that? Is it that we don't know what the demand is, or because as a public company you have to operate in a certain way? I don't know the answer for that. Unless I probably run a business of my own with that kind of cash flows. But that is something very interesting to watch actually in the next 2, 3 years. Why? So was there bandwidth on their side to really absorb this thing? I don't know the answer. And the other part is like we're not talking about workforce, so like I'm just giving in US dollars. Like it's not like they're getting paid like 150K or like 120K normal salary. Some of the software engineers get paid like 400K, 500K per annum. These are like really big dollar like jobs we're talking about. So that could be the factor of it. But on that note, I want to turn it to you. We can just take the example of like general
Mhm.
semiconductor sort of companies where the act of actually letting go people is not so much of maintaining your earnings per share or not spending your cash, but it's matter of actually not having negative cash flow. We're talking about life and death situation layoffs versus good to have layoffs in a way, right? I think it's an interesting concept working in manufacturing or even sometimes in retail store setting, how the operating leverage kicks in when you have like volumes going down, volumes going up. I just want to delve a little bit into that discussion. It's a useful supply chain area to understand, especially if you've been in the business where things can be very critical. And we're not talking about just saving for the sake of saying it's a life and death situation for companies like manufacturing
No,
companies.
yes. I think that's a very great comparison. Like, you can compare with the companies which have been in this business for a while, which I would call is a stable business, compared to the companies which are into this growing sectors like e-commerce, cloud, whatever you say. They're like a growing business. And The tact is the strategies of the companies are entirely different. So each sector, they actually react differently when they actually go into this kind of situation, especially when they see this downturn. Now, we can talk about different sectors like growing companies and stable companies. How do they react in during such situation? Now, we see that a lot of growing companies, they have been firing left, right, and center. Now, how in this situation the stable companies are reacting? Now, if I have to talk about stable companies, we don't get to hear a lot about them firing so many people. So what is that the difference that is causing to this? And what I understand from the stable companies is that they have this kind of constant workforce, and even when they have to predict the growth, or let's say they see that okay, in their whichever area they are in, and they predict that there can be some sort of increase in volumes, and as such they believe that with that, with the kind of workforce or whatever assets they have, they are still able to manage it, and that kind of don't tend to overreact as such. What they would is the kind of looking for a time period as such, that okay, like, hey, let us have some data point, and then we'll see how we can actually turn out the situation. Now, in this case, what they do is during especially downturn, yes, it's a critical situation for any company, especially when the volumes go down. And what happens is that the volume do make a lot of differences, because you have this fixed overhead cost, right?
Mm-hmm.
And when the volumes come down, your overhead cost doesn't change. It still
Right.
remains constant, because you have constant workforce, you have this machineries, you have this
Your
buildings, everything, right?
minimum full-time number
Exactly,
of folks working at a plant. So you may have variable
exactly.
labor, but the
Yes,
minimum
yes,
full-time
yes,
guys are
yes,
need to be there, whether you are at 30%
exactly.
utilization or whether you are at 85%
Right,
utilization.
right. So what happens is that when your volumes go down, so ideally what you're doing is like the per unit cost actually goes up, right? If you don't
Right,
actually
right,
react, though, because your overhead is constant,
right.
but your per unit cost goes up, and this is where the lever the company makes use of, especially when the volume goes up, and they can actually tinker around with their selling price. They can have with that, when they start tinkering with their selling price, they can actually increase their market cap, get more customers, and all those things. That is a lever they use. But especially when the volume go down, it becomes a very difficult situation, because ultimately, their cost per price is going up. Now, in such situations, the companies, they have options of, what they can do is they can do try to build some inventory ahead of time, and have go for some shutdowns for a period of time, so that they can actually bring down the operating cost. This is one of the things the companies generally do, right? Because, or the other thing which I told you, right? They first looking for all the variable costs that they can actually believe that they can trim it down, make it zero out, and all those things. Absolutely, that is the thing they actually look out for. And then yes, in a very bad situation as this, what you are saying is, yes, definitely they'll look for the teams which they believe they would have spent in for the future growth, which they believe is not happening now. So those are the teams they will go for, especially in engineering sector, or other sector, or other teams where they believe that the current team is not might not be adding too much of value addition for the company, at least for the short term. And those are the teams they would go after. But yes,
Yeah, yeah.
they would actually go for to see how they can actually reduce their operating costs, because they know that the volumes have gone down,
Right.
and they will look for options of how can actually they reduce their operating cost, because that is a lever that is
Yeah.
what they're going to use
Let
it
me
for.
let me add a small distinction. I think Satya was
Mhm.
talking about growing companies, and probably is trying to say more like stable slash matured companies. Uh, I want to provide some distinction even within the matured companies. Usually, you want to bucket them as, I would put them as cyclical and secular companies. Okay, and every company has cyclicality, but when I say secular, I'm saying not much of a demand change. So I can speak for a little bit with my experience in the food sector how it works, right? So the volumes don't really fluctuate beyond like a 5 to 10% range unless a category or a food trend is declining. I'm talking total volumes as a part. But in semiconductor, it can really go down 30-40%. Being a commodity business uh, is one problem you guys have on the pricing side. But I think I also want to highlight the end product effects, right? If you take something like a storage product like semiconductor, you might buy like a storage hard drive, and you don't may as a consumer level you may not buy it for 3 years, right? So that means there is a 3-year cycle time for your purchase. When the cycle time of purchase is long, you have cyclicality in the business. That's what happens in semiconductor. If you take like food business, normally you go to buy your groceries every week and you eat up all of it and you have to go back again. So there's no concept of buying for like a long
Definitely.
duration. So essentially that makes the business very secular in nature and the essentialness of the business. I mean, storage is essential too, but food is a lot more essential than storage. So those nuances also come into play. And I just want to actually sort of dive into slowly our third topic. Uh, how does a recession affect like different sectors, right? I think I'm probably speaking for it indirectly, but let me talk about food and you can just talk about other sectors, whatever come to your mind. Like, so in food sector, at least in the US, developed world, I think India probably will evolve there. Normally, food amount of food you eat at home versus eat away from home, whether in your cafeteria office or like restaurants, fast food, everything is a 50-50 split. This is across the board in most of the developing world. Take Europe, Australia, and US. I'm telling this based on the consumer insights I heard from like wherever I worked in the past. So in a recessionary environment, the share from food outside home actually comes into food at home because you spend less on like fine dining restaurants and you do some trade down to something like a McDonald's, and then further you do some trade down to I'll eat like instead of 5 meals at home I'll eat 7 meals at home. So essentially, if you are a food company in eating at home spot, you probably have like a sort of little bit of a bump. Again, the bump I'm talking about is not like tech companies 2030. We are talking really small amounts of bumps, which are easy to absorb. Like you said, at a utilization of 70, you go to 85 and you can easily absorb without much of incremental capital spent. So that's probably an example of how things might work in a recessionary environment where it can be fairly stable in a setting. In fact, it can be a tailwind.
No, yes, definitely. That I agree. This it actually yes, it actually kind of pretty much on high level does remain same across the sectors. Like as I said, right in semiconductor as well, right during recession, as I told you that the head cause is like sorry, overall head the expenditures and all, especially everything remains constant during the volumes. When the volumes go down, they have to look for measures such as to cut down their production because see, especially a capital, intensive
Intensive
industries
business.
like
Yeah, right.
semiconductor, right? They, if the machines are lying idle, it's a big deal because you have this depreciation cost involved and
Right.
all those things. So this it's a big deal, when the machines are lying idle. Now it's a catch 20, it's a catch, it's a very, what should I say, in a precarious situation where you can't even have those inventories build up just to utilize your machines to 100 percentage, because having inventories again a very because you're actually investing working capital in the inventories, right?
Working
More the
capital
inventory.
and probably in like a very high tech environment, there is a risk of like generation
Yes,
shifting.
yes,
So you cannot like
exactly. Yeah.
build ahead of time.
Exactly, yeah. You have to be very, very careful about your inventory. And inventory management, I would say, is a very key thing. The point that you've highlighted, right? Like there's a difference between stable companies and mature companies, and yes, which I would call it as the difference comes out to the inventory replenishment is what I would call it as. When you
Yeah,
talk about the cycle of 3 years compared to daily consumption, so this is what I call it as uh,
that's interesting. I'll highlight
replenishment.
probably another point. I think compared to food sector is there are food trends which keep changing, product innovations happen, but certain products, let's say like Kellogg cornflakes, has been around for 50, 60 years. Maybe their flavoring, few things here and there changed, but nothing has fundamentally changed in that product. Okay. And then you have certain soup products, which is not quite common in India to have canned soup, but in US, like Progresso soup or some of the canned soup, the shelf life is almost 2 years, sometimes even 3 years. Okay, so you can build actually inventory and keep it. That is possible,
Yeah,
because the nature of the product is very stable, and also the shelf life sometimes permits you can actually build. But in the case of like semiconductor, the risk of like technology changing
right, right.
rapidly, and then
Exactly.
it becomes another big burden, right? Yeah,
Yes, yes, yes. Inventory, that's what inventory replacement is the key. And not every company will have their own levers, right? As you said, the
yeah.
shelf life is one of the key thing. You can play around with that levers. You can decide what amount of buffers you need to keep so
Right.
that you can cater to your demand fluctuation and all those things. But in a tech sectors, you're right, the demand fluctuation happens in such a way that especially when there's a shift in technology, and if you're sitting on a piles of inventory, you cannot take that risk of building huge amount of
Right,
inventory
writing
just
off
to
that thing.
yeah just to buffer yourself against the demand fluctuation. And that's where it's a very difficult situation, I would say. And that's why the good companies, the smart companies, they have to take a very balanced decision, especially when the volumes go down or the recession that we are talking about. How do they actually decide upon cutting down their operating cost, right? Now, idle having your capacities being idle is not a good scenario to be seen. But then what I would call it as the biggest sin would be having sitting upon piles of inventory, and when you have low demand, right? Because you have this
Right.
holding
So
cost
you have
attached to
to
it.
balance all the things like your
Right,
capacity,
right,
your inventory,
right.
and then you build too much, you may have to cut prices. That makes sense. And I think one of thought came to my mind, like as much as we talk about it, semiconductor is the most sophisticated industry, but I was talking about food. One thing you can clearly see is, see, the economics of the business has nothing to do with the sophistication of technology. It has everything to do with the end customer, certain nuances and behaviors, because food is very sticky in nature, and then people don't like to change certain things. If you're buying a packaged food, you are looking for consistency, and you stick to a brand, and taste is a different thing. It has certain characteristics, makes it sort of very robust and stable in nature. On the other hand, I mean, semiconductor is like the most sophisticated thing, highly technical, very complex. uh, this is an example to highlight sometimes simple doesn't mean always bad, or complex doesn't always mean good.
Uh,
In a sense, I
I
think I
agree.
know we have probably a few minutes left here. I want to get us rolling into the next topic. What do you think would be the sectors which probably will be doing well in the next 2 3 years, as we are going to go through this, I would say, recession slash slow growth environment? I, I I'll take a shot at it, but I'll let you uh, think through if you have any thought. Otherwise, I'll start first, and then you can go after that.
Well, that's an interesting question, especially when you're talking about what are the sectors that will be shining for the next 2 to 3 years. Now we have seen that we have been all the world, the world used to look around for the tech companies, especially the
Right,
fan companies, because that's where we have seen over the
right,
past,
right.
that's where we have seen significant growth. Now, because of this downturn, we have seen how the tech companies got impacted, because these are the
Correct.
major ones that were driving all this S&P or even the other stocks sector, because that's where the major growth was happening. Now, what I would see is that yes, in the, at least for this year and next year, I would see that there will be good amount of progress, but yeah, that will not happen at the rate which was happening as such. There will be still some progress that will be made. But coming back to the technical sectors, what I would say, and it was also one of the good points that was raised, that especially in the sectors where we are talking about in the progress in AI ML as such, uh, still it's a very, what should I say, broad topic that we can talk about. And but many people are very very optimistic about these things, but it is not that it is going to happen it's in such a short span of time. But this is something I believe that it will happen over a period of time. But definitely yes, AI ML things, when I say, because the way they are going for automation, it will be quite surprising, I would say. We can see the kind of automation they can do in what all sectors. So this will grow, but again, as I said, this is a very emerging technology. We have to see how it's actually going to pace itself in the next 2 years. But then, apart from this, what I would feel is that cloud technology, I agree that which we even discussed in the previous episode, that this is one of the sectors which we believe it is going to grow for next few years, just like the e-commerce has grown. Though I agree that during COVID, we have seen a good amount of
But
demand
do you
for.
think there'll be a lot of, I mean, I think my light of the question is for folks who are starting to look for jobs, where should they also target? I mean, there's going to be some growth happening in all the tech companies too, but if they have potentially overhired already, they may not hire as much in the next year or
Yes,
two, right?
yes, yes,
In that
yes.
sense, like, uh, I was asking, like, do you see any companies which might be sort of still hiring and not putting any brakes on for the next two, three years?
Yes, yes, I would say that I know that it's like if you see across the sector, it's not that even the companies which are not hiring, not firing as such, but there I see that the companies have gone for hiring freeze. Even the companies that has not got
Hmm.
impacted badly, they have gone for hiring freeze. And whenever I feel for the candidates who are looking out, if they get an opportunity, especially in any of these companies, whether be tech firms and stable companies, I believe they have pretty much calculated. And if they're still hiring for it, that means it's not a short-term stint. It has to be a long-term growth. Because I won't name the company, but I was reading a statement as such. Though they have been firing in some of the teams, but they are still as they have been firing in some of the teams, but they would still be hiring in some of the different sectors. That means overall company wise, yes, they are trying to,
So probably even
it's
within these tech companies,
yes,
there could be sort of mixed thing. Like as an
exactly. They are kind
example,
of going
maybe
for
Facebook may not be hiring in social, but hiring in like VR, AR
it's
kind of thing.
basically a reallocation that is happening. I was actually reading a very interesting article, like one of the HRs, he was actually saying like which are the teams within the company, right? Which are the teams that are pretty much they are in a risky position compared to the teams which are okay, and they would still continue to survive in these companies. Like we might talk a lot about HR teams getting impacted, but they have to still be there around to lay off the peoples. That means
Right,
they still have the job to do, right? Same case with finance, because they have to keep reevaluating their situations, their
right,
revenues,
right.
tie up how
They
they
would
are going to
probably
point.
trim like on the recruiting side and not so much on the other
Exactly,
thing.
exactly. So the teams that he actually mentioned will get impacted, like the event management teams or planning teams. So
Yeah,
the folks who are actually looking out for, they need to assess which teams or what is their expertise level, which teams they fall under, and how they
right.
can get impacted. And I believe that especially now we are with beginning of the year, we might and it's not that we are done with this. That's a good point that you raised, that how does the company know that whatever they have done, the 10%, 5%, do they know is it enough, or do they have to still do it? It's a very interesting question.
Right.
Now, given in that situation, if from my experience, if you would see, I would definitely would look out for the companies which has not been very where they have trimmed down a lot of people. That means they still see that stable growth, and if you get that opportunity, I would say you grab with their both hands. But
So I
in
think
the
Satya,
team,
to summarize, you're saying look for the tech companies if there are certain areas of growth, if there are positions there, or companies where they are not laying off anybody and probably slowly hiring. That's
exact,
broadly
yes,
you're saying.
yes, that's my
I have
take.
a slightly different answer for the question. So I
Hmm.
think at least based on whatever I'm reading, broad trends. We talked about the Chips Act in the U.S. last episode. I think there's a gigantic amount of investment still which will continue. I think there's a little bit of a
Correct.
pullback from Intel, some of the companies, but the fabs will be built in the US, like from Samsung, Micron, and others. So I would say any companies which provide semiconductor capital goods. I mean, I can think of Applied Materials. I'm not that familiar, but there would be other companies like that. I think they will be definitely doing well. Just broadly thinking about it, because semiconductor capital goods, if they get an order, it takes a year or two build to make the product and sell them. There is no way that they're going to put a stops on the actual order and then again start again. It's never going to work. These are long lead, really, like you're giving machinery to build a plant. So that's one area I could think of. And the other one I would say is fairly consensus, and you can feel it in India and here almost, is like the EV trend is very, very real. We haven't seen other car companies outside Tesla actually come out with EV cars as much in the US. They're slowly coming out, but I think in the next year, year after, there's going to be a huge amount of a leap forward towards the EV sector. And then the batteries. I'm hearing about huge amount of battery investments happening in Southeast US, particularly closer to where these German car company plants are set up in South Carolina, Georgia, North Carolina, Kentucky, Alabama. So
I think,
I
yeah,
feel there'll be a lot of investment in building the plants, which will be very hard goods like, and unlike the growth we have seen last 10 years, which is more consumer facing and more digital. And I'm giving you things which are more like hardcore operations, things like more supply chain like plants, and then probably B2B in nature.
yes, one quick point for a few seconds.
Yeah,
When you talk about EV, look out for the sectors, for the companies which provide the components to an EV, for an assembly company like a EV, right?
yeah.
So those sectors, I'm sure, will be in a green light and needs to be looked out for.
No, great point. I think that'll be along with the like a cap goods, semiconductor cap goods to
Yes,
build the other plants, right? I think we're
exactly.
running out of time here.
All right.
Maybe we'll wrap here and catch up next week again for some other episode.
All right. Have a great day.
All right.
Bye.
Thanks, Satya.
See you.
Bye.
Bye.